Good morning to the most incredible XRP army. I'm gonna waste no time, let's get right into the video. Let me tell you something that should make everyone in their chair sit up right now. If you hold XRP or are planning on getting any amount of XRP, you need to hear this. You need to hear this. On one side, you have Tom Lee calling for the end of the 4-year cycle and positioning for a structural super cycle driven by utility, yield, and tokenization. On the other side, you have Michael Saylor executing one of the most aggressive Bitcoin accumulation and yield engineering strategies ever attempted in public markets. These are not small opinions. These are trillion-dollar frameworks colliding in real time, and the outcome of this collision is going to define where capital moves next. These next moments are going to be absolutely massive, so I need you, the amazing viewers, kick back, get comfortable, smash the like and subscribe button so this video reaches other legends just like you. Now, let's get right into the video. Kicking this video off with a bang. What made this moment so powerful at the Binance event was not the charts or the buzzwords, it was the clarity of conviction. Everyone was pitching a book. Everyone had a framework, but Tom Lee stood apart by openly challenging the sacred cow of the 4-year Bitcoin cycle. For years, people have treated the halving like a law of physics, but Lee broke that assumption apart by showing how multiple macro systems once followed clean 4-year rhythms and no longer do. Industrial activity, monetary expansion, global liquidity, these cycles have shifted, stretched, and in some cases completely decoupled. His argument was simple but explosive. Bitcoin has tracked these macro forces more closely than the halving itself, and if those forces are no longer cycling the same way, then neither should Bitcoin. That single idea alone reframes everything from timing to allocation to risk, and it sets the stage for why this debate goes far beyond price targets. When Tom Lee said the next 8 weeks could shatter the 4-year cycle narrative, it was not a throwaway line. It was a direct challenge to an entire generation of market participants who anchor their decisions to past patterns. He tied Bitcoin's previous peaks and troughs not just to the halving, but to ISM data, liquidity conditions, and global growth metrics that have already broken their historical behavior. This is where the supercycle thesis starts to become dangerous in the best way possible. If Bitcoin does not peak when people expect it to, and if liquidity accelerates instead of contracts, then capital does not rotate out on schedule. It compounds, it snowballs, and that environment fundamentally changes which assets benefit the most. This is where Lee begins to separate Bitcoin as a store of value from Ethereum as a productive financial layer. And that distinction is everything. Michael Saylor's strategy sits on the opposite end of the spectrum, and it is just as bold. MicroStrategy has effectively turned itself into a leveraged Bitcoin vehicle with a yield wrapper built on top. The numbers alone are staggering. Billions in daily trading volume, rivaling or exceeding legacy financial giants. Capital raises structured to avoid selling Bitcoin while sustaining dividends. Preferred equity instruments designed to attract yield-hungry investors who want exposure without volatility. This is financial engineering at scale, and it is undeniably brilliant in execution. Saylor is betting that Bitcoin's appreciation will outrun the cost of capital, and that demand for yield will funnel massive pools of money into his structure. If Bitcoin explodes higher on schedule, this machine prints. The risk is not hidden, it is simply deferred. By putting a window on Bitcoin performance, even indirectly, Saylor introduces timing risk into what many believe should be a timeless asset. The yield works as long as the underlying asset continues to cooperate. This is where Tom Lee's framework diverges sharply. Instead of depending on appreciation alone, Lee is leaning into Ethereum's ability to generate native yield through staking while maintaining a clean balance sheet. His numbers are not theoretical. A few percentage points of staking yield on a massive ETH treasury translate into hundreds of millions in annual income without financial gymnastics. That is real cash flow derived from network utility, not leverage. In a world obsessed with yield, that distinction matters more than people realize. What makes Ethereum central to this debate is not speculation, it is infrastructure. Tokenized treasuries, real-world assets, private credit, stablecoin yield, all of it is being built overwhelmingly on Ethereum. While Bitcoin dominates the narrative as digital gold, Ethereum quietly dominates the plumbing of the new financial system. This is not opinion. It is observable reality in on-chain data and institutional adoption. When Tom Lee talks about ETH as a utility asset, he is not diminishing Bitcoin, he is contextualizing it. One secures value, the other moves it, multiplies it, and monetizes it. In a liquidity-driven expansion, utility tends to capture more upside because it sits closer to economic activity itself. The yield conversation is where the philosophies fully split. Saylor's variable rate preferred equity is an innovation that only exists because markets are desperate for yield and willing to accept complexity to get it. It is engineered, synthetic, and dependent on confidence. Lee's yield comes directly from protocol mechanics that reward participation in securing the network. One approach requires constant access to capital markets and investor appetite. The other compounds quietly as long as the network grows. Both can work, but they perform very differently under stress. That difference becomes critical as markets scale and volatility inevitably returns. Zooming out, the innovation wave does not stop with Bitcoin or Ethereum alone. New financial instruments are being created at a pace traditional finance can barely process. Some will fail spectacularly, some will redefine how capital flows. The important signal is not which experiment wins immediately, but where the builders are focusing their energy. Smart contracts, tokenized assets, programmable yield, these are not being built on Bitcoin at scale. Even long-time Bitcoin advocates are acknowledging that Ethereum has won the smart contract war. That does not invalidate Bitcoin's role, it simply clarifies it. Different tools for different jobs, and markets reward the tool that solves the most problems in a growth phase. The clash between Bitcoin and gold that played out on stage highlighted this perfectly. Physical scarcity means nothing if an asset cannot move at the speed of modern finance. Transportability, verifiability, divisibility, these are not philosophical points, they are operational realities. Tokenized commodities solve problems gold never could on its own, and they do it on blockchain rails. Once again, Ethereum sits at the center of that transformation. This is why utility narratives eventually overpower purity narratives. Markets care about what works, not what feels ideologically clean. The ETH to BTC ratio is the scoreboard Tom Lee is watching, and it tells a story most people ignore. Ratios strip away emotion and focus on relative performance. If Ethereum's utility value accelerates while Bitcoin consolidates as a reserve asset, that ratio moves. Historically, when it moves violently. Lee's projections are built entirely on this relationship, not hype. If Bitcoin reaches higher valuations and Ethereum simply reverts to historical averages relative to Bitcoin, the upside for ETH becomes mathematically explosive. That is not a prediction, it is arithmetic. Price targets grab attention, but positioning reveals conviction. When Ethereum purchases slowed, it was discipline. When they accelerated again, it was signal. Accumulation behavior from informed players matters more than commentary. Pullbacks that hold, ranges that build, these are the foundations of expansion. Ethereum stabilizing while its underlying economic activity grows is exactly the kind of divergence that precedes major repricing events. This is how supercycles are born, quietly, before the crowd catches up. The real takeaway from this entire debate is not choosing a side, it is understanding the game being played. Bitcoin represents monetary certainty and scarcity in a world that lacks both. Ethereum represents programmable finance in a world desperate for yield and efficiency. Michael Saylor is optimizing for one outcome with relentless focus. Tom Lee is positioning for a broader structural shift in how value is created and captured. Both strategies can succeed, but they succeed under different conditions. If liquidity expands, if tokenization accelerates, if yield remains king, the advantage tilts toward utility, and that is the axis on which this entire supercycle thesis turns.